By nature, I'm a minimalist in many parts of my life. Letting go of clutter, it's paramount for me, which sometimes clashes with my wife's need to hold on to things for sentimental reasons. I guess there are the esoteric reasons for me being this way, like making room for new things in your life. But at the root of it, I just like simplicity. When I entered the initial stages of trading, I was overloaded with information. Most of it redundant and useless, all promising to offer the riches behind that candlestick and bar chart. As you have no doubt experienced, trading riches are out of reach for many and delayed for a long time for others. More recently, I was involved in a conversation with other traders and a really great group of people about how some trading systems evolve into complexity. Too many moving parts in anything is never a great thing, but that's extremely valid in trading. Ever heard the saying, everything should be made as simple as possible, but not simpler? You have trading methods that use so many variables that some of them end up contradicting some of the other variables. There's so much redundancy in a lot of systems, so many things that have nothing to do with how markets work, that there truly is no statistical edge in the method. You can also have too many choices to make, too many different ways to look at information, that you end up lacking any sort of long-term consistency. Limiting the degrees of freedom in any trading system is step 2 after step 1, which is having a statistical edge to help you on the road to consistency in your work. When those not involved in the markets ask me about the confusion of trading, I tell them that at the core of it all, it's relatively simple. Of course, when you show them a chart, they think you just stepped off of the crazy train. Simple, yeah, right. Well, it is true, but humans love to make things more complex, especially in trading. Perhaps it's the whole illusion of control rearing its ugly head. Take the actions of the market. If you simplify the moves, what do we really have? Two things. We have continuation of trends, and we have the mean reversion of said trend. Clearly, individual price movements have a huge array of influence that make them move, but taking a bird's eye view, we have a trending market and a reversing market. Now, you have two options, and that's either to get involved in the trend or get involved in a possible reversal. And I can already hear some of you saying that sideways is also an option. It certainly is an option, and selling highs and buying lows in these ranges can be valid plays. However, at some point in time, you're going to have to make a decision, and that is, will you play a continuation of the trend or will you play a reversal of the trend? At the heart of everything you do, are you not either playing a continuation or a reversal even side of a range? Sure you are. As a trader, you have to decide where you're going to lay your cards and then find your way into whatever move that you anticipate. Inside of all of that is where you lay out your edge and let the expectancy of your trading edge play out. Your job is to decide if you're trading the trend move or setting up for a position in the reversal. Simplistic? Yeah, it sure is, but that's what we do as traders. Choice A or choice B. Your job is to find an edge that gives you a high probability of A or B happening and ride that edge consistently every single time it appears. It does not have to be more complex than that. The secret is in finding what conditions are present when one move overrides the other. There are clues right on the chart, and your job is to decipher those clues and give yourself a working trading system that you employ over and over again. Simple, but not easy.